Welcome to Unpopular Investing, the channel where we look at stocks that most investors have forgotten about or never heard of. Today's topic is a company called Spire Global, which is a space data company that dropped 50% overnight and has since traded flat. So, is this a buying opportunity or is it still too risky? We'll find out in this video. But first, some of you might be wondering, what does Spire Global even do? So, let's do a quick introduction before analyzing the stock. What is Spire Global? So, Spire Global operates a fleet of multi-purpose satellites that gather real-time data on weather patterns, ship locations, and aircraft movements. Their customers include commercial businesses such as airlines, logistics firms, and insurance companies, as well as government agencies. They split their business into four key segments: maritime, aviation, weather, and earth intelligence. Now, spoiler alert, the maritime division is the reason why they dropped so much all of a sudden. So we'll come back to that later. But first, let's talk about their tailwinds. This company has several important tailwinds, the first of which is climate change. Government agencies and companies are rushing to understand weather patterns to forecast and deal with potential future climate disasters before they happen. So they are using firms like Spire Global for their AI analytics and unique data collection offering. Speaking of analytics, the second tailwind is the advent of AI, which is being used to improve their predictive capabilities and adding more value to customers. In addition, the new large language models such as OpenAI and Anthropic are so data hungry that they are willing to pay for new data sources such as Spire's space data. So that could be a parallel fast growing revenue stream in the near future for the company. They also have Earth observation, as we saw earlier, and with the growth in defense industry, this could be a very strong source of revenue, as exhibited here by the $237 million contract from the US Space Force, which is equal to their total market cap. Now, having said that, why did the stock actually crash this year? As I said before, it has to do with the maritime division. And the maritime division was supposed to be spun off, but then there were rumors earlier this year that the spin-off might not be happening. So why is the spin-off important? Well, the spin-off was supposed to allow them to eliminate debt and raise capital to strengthen their balance sheet and maintain liquidity so that they don't have to dilute shareholder value and sell stock to raise money. Instead, they sold off one of their units, and now that spin-off actually went through successfully in April, but the stock hasn't reflected this change. When we look at the numbers, when we look at the numbers of their closest peers, Black Sky, Planet Lab, and Redwire, Spire actually has the lowest price to sales ratio at just 2.3 versus 4.7 for Black Sky and 8 for Planet Labs. It does have lower gross margins than its peers, but importantly, Spire holds $136 million in net cash, while both Black Sky and Redwire carry meaningful net debt. Planet Labs has more cash, but trades at a much richer valuation, while Black Sky is closer to break even with stronger margins, but the debt load limits flexibility. So, on a risk adjusted basis, Spire may actually be more interesting, especially if growth accelerates, margins improve, or the valuation increases. So, why might Spire be a buy? Well, if it re rates its price to sales ratio to just 4, that's a 74% upside without taking into account any increase in sales or margins. Although their margins are relatively low, they're building a high margin business, and with time, the capital expenditure required to build out their satellite constellations will get lower because the satellite constellation would already have been built out, and they could essentially get free money from or higher margins from every additional customer that they acquire. And most importantly, they have no debt. So there is no risk of dilution for the next 2 to 3 years until the cash balance becomes low. So now we talk about the risks. What are the risks? As mentioned, they're burning a lot of cash, about $36 million per year. And with their $136 million in net cash, they have about 3 to 4 years runway before they have to raise more money if they continue burning in the same way. But if you buy this stock, you're betting on their growth, allowing them to eventually break even and start becoming cash flow positive so that they don't need to raise capital. And this high cash burn is actually true for all companies in this sector. So if you're interested in the space sector, then you can't really ignore the cash burn. You need to just look for a company that can handle that cash burn, which in this case, Spire can because of their new capital raise. The second risk, and this actually has been happening a bit in the past few years, is slower growth. They have been slowing in growth, so we need to kind of bet on or hope for that the growth stays the same or reaccelerates. And I think with the US government investments in space and in defense and climate change, I think there will be a faster growth, a reacceleration. But of course, this is always a risk. Nobody knows the future. So we need to bear this in mind. And lastly, there's always a risk of satellite damage in space. Anything can happen in space. It's a very uncontrolled area. Whether it's space debris or solar storms, there could be damage to satellites. And that satellite damage could mean that they have an unexpected increase in capital expenditure. So they need to spend more to just repair the constellation, essentially, right? So that is definitely a risk, but that's again a risk for all space companies. So all companies in this industry. Having said that, the bottom line here is that Spire is trading at a discount to its peers. Its debt-free balance sheet and scalable business model make it an attractive potential investment with positive macro tailwinds. If the management can prove its operational story in the next few quarters, especially with the help of defense and AI tailwinds, this might be one of those unpopular opportunities that pays off. Based on what you've heard, do you think that Spire is a buy or is it still too risky? Let me know in the comments below. Thanks for watching Unpopular Investing. Please leave a comment, let me know your thoughts, and press the like button if you enjoyed this video. I'll see you in the next one.